So today in this video I'm going to be explaining about how funding works in basically any startup, no matter how big it gets. Firstly, before understanding how funding works, we need to understand about funding rounds. Simply, there are 3 steps for funding. First is pre-seed/seed round. Second is a Series A round, and then Series B and C rounds, and so on. So firstly, let's talk about pre-seed/seed round. In this stage, we get funding from the owners, which is called equity funding, and then we get funding from our family and from angel investors. I'll explain what these people are later in the video. So these people pay for product development and early market tests, basically to develop a prototype and to see how the market behaves or responds to the product. Now the second stage is Series A stage. Now in this stage we get our first VC investment, which is venture capital investment. This investment is only received after we have a good prototype and the market has responded positively to our product. Basically, in case of tech startups, we get around $2 to $15 million in Series A funding. Now for Series B and C and beyond, so for this Series B and C, we basically get more VC rounds for growth, but while we do get more funding, we also dilute our shares. I'll explain that later on too. So Series B is basically for more venture capital funding, while Series C is usually for IPO prep, so the company goes public and has shares for interested people to buy, or it starts acquisitions. Each round involves sharing shares at higher valuations. So that means in each round, if a share is valued at $10 at Series A, then it's valued at $20 at Series B, and then $30 at Series C. Obviously, it does not work like that. Share value grows up exponentially in case a company goes public or it reaches Series B or C, but this is just a basic example. With every new round, founders' percentage ownership shrinks. This is called dilution, as new investors buy in. So we only have 100% of a company. So the new shares have to come from somewhere. And when venture capitalists are involved, they do not dilute their own share, but rather the founder's share to provide the new shares. Now, second thing we need to understand is what is venture capital itself. Venture capital is equity financing in exchange for ownership plus active role in decision making. So you give a part of your company to a person, a venture capitalist. They invest money in your company and you give them ownership. Not only that, they need an active role in your company and they influence your decisions, and they also, many of the venture capitalists demand a board seat and like executive decision making too. Next thing we have is founder equity and dilution. So founder equity basically means how much a founder owns the company they founded themselves. Obviously there are basically more than one founders in each company, but that means if 2 people opened a company, so a founder equity means their share of company combined. Now what is dilution? Dilution means when new shares are issued, the existing owner's share percentage decreases. But as I told you before, the existing owner's share percentage which decreases, it's mostly the owners, not the venture capitalists. They already have like anti-dilution laws when they give you the investment. So these protect the venture capitalists from basically dilution of their shares. Now last thing, what are the alternatives to venture capital? I would not say that venture capital is a bad thing necessarily, but I think it comes with a lot, it with its set of drawbacks. So, what are better options that might be more suitable for your company? First option may be bootstrapping. Bootstrapping basically means self-funding with personal savings and early revenue. Whenever you open a company, you have some money saved up, so you invest your own money, and later on when the company starts making some revenue, you invest it all back into your company. This method basically helps you keep your equity intact, but with this method, speed is obviously stunted because your company may not grow as much with minimal investment, because normal people who start a company do not have millions of dollars saved into their bank accounts. So next thing we have are angel investors. So what are angel investors? I think angel investors and venture capitalists, they are like complete polar opposites. How so? Obviously both angel investors and venture capitalists are people with money, but these angel investors, they invest before the series A round, and they invest on the seed round where the product is just being developed and prototyped. They do take equity. Basically no one is going to give you money for free. Obviously they expect some profit and return. But what the core difference, I think the nuance in here, is that the control they exert is very minimal. They do not want executive decision making, and they are not an active participant in your company. They are basically like silent partners. So you can have more flexibility and control within your own company. Now, I cannot say that angel investors exert lower control in every case, but mostly in comparison to venture capitalists, they exert way less control. So next alternative is crowdfunding. Now what is crowdfunding? Crowdfunding is basically the process of raising small amounts of money from many people. So these would be consumers who are interested in your product after it is developed. So crowdfunding pays the investors in products and perks, not equity. So you have your equity, you get your investment, and you give the investors back your own product and your own product and perks. So basically this method, it's foolproof. You get investments, and you have customers who will buy your product after it is launched. So it's sort of like an insurance. Also, people have the psychology of sunk cost fallacy. So if they have invested in a company, they will be very invested in the company's growth itself. So they will try to like advertise the company to other people and even buy more stuff than they normally would, because they are way more invested in the company. So the last option to venture capital is debt and financing. So this is basically you taking loans, but again it has its own caveat. You need to have collateral, and you need to pay some amount of interest, I don't know, like every month or year.